Gold has fascinated people for thousands of years. Empires fought wars over it. Kings filled entire vaults with it. Today, countries still store thousands of tons of it. People buy it during financial crises. Investors rush toward it when markets fall. Jewelry stores sell it every day. Central banks continue buying more of it. But here's the question. Gold doesn't produce food. It doesn't pay dividends. It doesn't generate rent. You can't eat it. You can't use it to power your house. So why does the world still treat gold like one of the most valuable things on Earth? The answer isn't as simple as supply and demand. It involves history, psychology, economics, and one feature that almost no other asset has. Let's break down why gold remains so valuable. For most of human history, people needed a way to trade. Bartering worked at first. One person traded wheat for milk, another traded fish for cloth. The system quickly became inefficient. Finding someone who wanted exactly what you had became difficult. Civilizations needed money. Many objects became money. Shells, salt, livestock, copper, silver. Eventually, gold rose above the rest. Why? Because gold solved many problems. It was rare. It didn't rust. It didn't decay. It was easy to divide into smaller pieces. It was easy to recognize. And people everywhere agreed it had value. This shared belief made gold one of the first global forms of money. Entire economies were built around it. Many countries created currencies backed by gold. This became known as the gold standard. Every paper note represented a certain amount of gold stored in a vault. People trusted the paper because they trusted the gold behind it. That system lasted for generations. Even though most countries no longer use the gold standard, the trust never disappeared. People still associate gold with stability. That reputation took centuries to build. The next reason is scarcity. Gold isn't the rarest metal on Earth, but finding enough of it is difficult. Mining companies search for years before opening a new mine. Once they find a deposit, they spend hundreds of millions, sometimes billions of dollars, preparing the site. Heavy machinery, roads, workers, processing plants, environmental approvals. Years pass before the first ounce reaches the market. Even after production begins, extracting gold remains expensive, or contains only tiny amounts of gold. Many mines process several tons of rock to recover a single ounce. That makes new supply slow. Unlike paper money, nobody prints more gold during a financial crisis. Its supply grows gradually every year. That limited supply helps protect its value. Now compare that with paper currency. Governments and central banks control the money supply. During recessions or financial emergencies, they often create more money. This increases the amount of currency in circulation. If the supply grows faster than the economy, purchasing power falls. This is inflation. Inflation means your money buys less than before. A meal costs more. Fuel costs more. Rent costs more. Gold behaves differently. Its supply changes slowly. Because of this, many investors view gold as a store of value. Not because gold always rises in price, but because currencies sometimes lose purchasing power faster. This explains why gold often becomes popular during periods of high inflation. Gold has another advantage. Almost every ounce ever mined still exists today. Unlike oil, coal, or natural gas, gold does not disappear after people use it. A gold coin, made hundreds of years ago, still holds value today. Ancient jewelry still exists. Gold bars stored decades ago remain unchanged. This creates a global supply, built over thousands of years. Owners decide when to sell. During uncertain times, many refuse to sell at all. That reduces the amount of gold available on the market and supports higher prices. Transporting gold is another reason it became valuable. A small gold bar worth hundreds of thousands of dollars fits inside a backpack. Millions of dollars worth fits inside a small safe. Imagine trying to store the same value using iron or copper. The weight would become impossible to manage. Gold concentrates enormous value into a small space. This made it useful for merchants, governments, and banks long before modern financial systems existed. Gold also performs well because almost everyone recognizes it. A farmer in India, a jeweler in Italy, a bank in the United States, an investor in Japan. They all understand what gold is worth. Very few assets receive this level of global recognition. Real estate depends on location. Businesses depend on management. Currencies depend on governments. Gold crosses borders without losing its identity. That universal acceptance gives it a level of liquidity that few physical assets share. This worldwide trust creates another advantage. Gold trades around the clock in financial markets across different continents. Buyers and sellers exist almost every day. Investors do not need to search for someone willing to accept gold. Large exchanges, banks, and dealers already provide a market. This constant trading keeps gold connected to the global economy and helps explain why its price responds so quickly to major world events. The next reason involves fear. Financial markets move on confidence. When confidence falls, investors search for safety. Stock markets become volatile. Banks fail. Political conflicts increase. Currencies weaken. Money flows toward assets people trust. Gold has earned that trust over centuries. Economists often call gold a safe haven asset. History provides many examples. During the 2008 financial crisis, investors bought gold. During periods of high inflation, demand increased. Central banks continue increasing their gold reserves even today. Why? Because gold doesn't depend on one country's economy. It isn't tied to one company. It doesn't rely on one government's promise. That independence gives it a unique role. Central banks understand this better than almost anyone. Countries store gold inside highly secured vaults. The United States owns more than 8,000 tons. Germany owns thousands more. Italy, France, China, India. Many nations continue adding to their reserves. If gold had lost its importance, these institutions would have sold it years ago. Instead, many continue buying. That tells us something. Gold still serves a purpose in the global financial system. Another factor is demand. Many people assume gold exists only as jewelry. Jewelry accounts for a large share of global demand, especially in countries like India and China. Gold also plays an important role in technology. Manufacturers use it inside smartphones, computers, medical devices, satellites, spacecraft, electrical connectors. Gold conducts electricity well. It resists corrosion. It lasts for decades. Industrial demand represents a smaller share than jewelry or investment demand, but it still supports the market. Investment demand creates another layer. People buy physical gold bars, gold coins, gold exchange-traded funds, mining company shares. Some investors never touch physical gold. Others refuse to own anything except real bars stored in secure vaults. Different methods, same goal. Protect wealth. Gold also benefits from psychology. Humans place value on things they believe are valuable. That sounds obvious, but this principle shapes entire economies. Diamonds, luxury watches, fine art, rare collectibles, all depend partly on shared belief. Gold has one advantage over many of those assets. That belief has survived for thousands of years. Generation after generation passed it down. Parents gave gold jewelry to children. Countries stored gold. Businesses accepted gold. Markets traded gold. The cycle continued. Very few assets have maintained trust for such a long period. That history matters. Now let's address a common question. If everyone stopped believing gold had value tomorrow, what would happen? Its price would fall. The same applies to paper money. Currencies have value because people accept them. Stocks have value because investors believe companies will generate future profits. Every financial asset depends on confidence. Gold simply has one of the longest records of maintaining it. Does this mean gold is always the best investment? No. Gold produces no income. It pays no dividends. It generates no cash flow. Stocks often outperform gold over long periods because businesses create profits. Real estate produces rent. Bonds pay interest. Gold serves a different purpose. Many investors treat it as insurance. They don't expect it to outperform every asset. They expect it to hold value during periods when confidence disappears. That role explains why many investment portfolios include a small allocation to gold instead of placing everything into it. So why does gold remain valuable? Because it combines several rare qualities: limited supply, global recognition, thousands of years of trust, strong demand, protection against uncertainty, and independence from any single government or company. Those factors continue supporting its value today. The world has changed dramatically. Currencies became digital. Payments happen instantly. Markets operate around the clock. Yet gold still sits inside central bank vaults. Investors still buy it. Families still pass it down through generations. That tells us one thing. Gold's role extends beyond being a shiny metal. It has become one of history's most trusted stores of value.